Part of the reason I would say the answer to that, at least in my analysis, is that this is a market and you've been around it long enough that you can either agree or disagree. You have a legitimate case to agree or disagree. This is a market where you mostly got burnt over the years, not made a ton of money. Windows were the shortest windows and they tend to have closed faster than most other markets. In fact, if we can look back, we can point to say, okay, there was a little bit of a run during COVID. Before that, 2011. Before that, 2003. There hasn't been a great bull market like in stocks and bonds that basically lasted for 40 years. So the natural tendency is for the shareholders, even though they're buying them as a proxy to the metals themselves, is nevertheless. That's why people couldn't understand 3 weeks ago when I said I'm selling off my juniors and all this. How could you? The gold's going through. It's going to go through 5 and then went to 50. To be where I've been is in recent days. I've actually talked about this is a typical, unusual for gold and silver, but not unusual for 100 years worth of trading of a parabolic rise that we saw. Anything, and you can look back at the text, anything when they go like this to this to this, that move will eventually end. Now, you don't know where it's going to end, and it can end usually higher than you thought and last longer than you thought. But they tend to be in, I don't know if you want to say blow-offs, because many times people think blow-off is the ultimate top. I don't think it's the ultimate top, but that was the climax to this move. And you're right, if it would have continued up, it'd be hard to then keep explaining it to be anything more than technical stuff that's forcing it. And God knows, does somebody know something that almost the rest of the world doesn't know? Because it would have been one thing if they were going and the stock market was getting crushed and bonds were getting crushed. But when the stock market's making all-time highs and gold is, hard assets and financial assets usually went against each other in most of my career, Steve. So when they're both going and making all-time highs, you have to ask yourself, what is going on? And you're right, if it would have continued. But I think today we saw the way that we had the reversal. And it's very, very healthy and good if you're bullish. Don't be disappointed. It would have been worse off if we would have continued straight up. If you really want to believe in 7,000, 8,000, 10,000 gold, just remember how hard it was to believe 5,000 gold 18 months ago. But if you really want to believe that now, a good consolidation period now is good. And a couple other things, Steve, I don't want to run on, but I want to get them out because they're important. Remember, especially for I know we're probably going to spend some time talking about juniors, the biggest negative to juniors has not been the metals prices, but the competition that was taking away the typical investors that would normally come to the juniors, and that was cryptocurrencies. And you are seeing the beginning of the end to the biggest promotion hype product that ever walked on the face of the earth. Forget about tulips and all, and that's Bitcoin. Bitcoin is what they call it. I call it Bitcoin. That's extremely important. NFTs are blown up. The memes are coming down real hard, and now the cryptos. And that money would have made it normally to the metals, either into the metals themselves, the mining shares of the juniors. And that's good because in the next leg up, we won't have that absorption taken away, instead coming into the metals.
For years, junior mining shares competed with cryptocurrency for speculative attention. Bitcoin, once the headline-grabbing asset, siphoned investment away from metals. But as crypto's hype fades, especially following the collapse of NFTs and meme tokens, capital is returning to metals. This realignment could fuel the next leg of the gold and silver bull market. The market is shifting, drawing interest from mainstream investors who previously ignored mining shares. Hedge funds and institutional managers, even those unfamiliar with metals, are now exploring opportunities for stable cash flow, signaling that gold and silver remain more relevant than ever.
Part of the reason I would say the answer to that, at least in my analysis, is that this is a market and you've been around it long enough that you can either agree or disagree. You have a legitimate case to agree or disagree. This is a market where you mostly got burnt over the years, not made a ton of money. Windows were the shortest windows and they tend to have closed faster than most other markets. In fact, if we can look back, we can point to say, okay, there was a little bit of a run during COVID. Before that, 2011. Before that, 2003. There hasn't been a great bull market, like in stocks and bonds, that basically lasted for 40 years. So the natural tendency is for the shareholders, even though they're buying them as a proxy to the metals themselves, is it never lasts. That's why people couldn't understand 3 weeks ago when I said I'm selling off my juniors and all this. How could you? The gold's going through. It's going to go through 5 and then went to 50. How could you do it? Because the anticipation already was by the people that own it is, as soon as this metal stops going up, these things are all going to come down. So I'm going to beat it this time, and that's part of the reason. And Steve, we have not had a large scale listening audience until most recently. This is an industry until most recently, even for the majors, was limited to institutional people who focus on it. Now, if you talk to the majors, especially the shows that you just were at and a couple others, over half the crowd are generalist money managers. These are not people that normally look at the metals. I just had a group here. I have 2 hedge fund friends. They manage probably $25 billion. And they never looked at the mining shares. They've just gone to 4 conferences in a row because they're recognizing for the free cash flow these things are going to make. Think about this, Steve. Even if gold doesn't go up another dollar this year, just stays at 5,000. Look at your Canadian producers, what they're going to make versus what other industries. Everything else is rolling over, the AI, all of that stuff. So it's attracting different eyes now. So you're not likely to get that 2 steps, see it back down. That doesn't mean they're going to keep making 130-something% a year, Steve. But I still think we're far, far from over in this bull run in the metals and the mining shares and the juniors.
Historically, metals markets have offered short-lived windows of opportunity. Unlike stocks or bonds, which can sustain bull runs for decades, gold and silver cycles are intense but fleeting. This explains the volatility and rapid corrections in junior mining stocks. However, the current bull market differs. Retail investors are entering, and institutional interest is rising. Even with temporary pullbacks, fundamentals remain strong. The consolidation we're seeing now is a natural part of growth, allowing markets to stabilize. Investors who remember past cycles understand that corrections aren't failures. They're necessary pauses before new highs emerge, reinforcing the resilience of this metals bull market.
VRAC, I used to MC that show for 25 years to 2013 when Joe Martin, father, ran it. And we used to use that as an indicator. There were times when you'd have a room and there'd be just 3 people there and 2 are eating a sandwich and you're trying to speak, kind of stuff. And then it was filled up to the rafters. But I think, I want to say, because it's a crime to say it, this time it's different. What's a little bit different this time is people have now heard that maybe don't play these things normally about the crisis in metals itself, critical minerals and all of that. And these are now shows where they can go out and find out about this. The general financial service firms in the US are not yet holding shows for public at large here to go learn about critical minerals. So I wouldn't be surprised that, unlike years ago when it was mostly Canadians within 100 miles of Vancouver that went there, that 25% of their audience traveled significant distance to go there. And I think we're going to see that more and more as we get into 2026. And because it's come recognized by the average person that the world is being divided and groups are being formed and people are dropping allies like Canada and the US and all. And it's almost like remember used to say, every man for himself. And everybody's got to try to get their hoard of metals now in order to continue growing their economies and all. So we're far from over, but we were much needed, as you and I speak here, for a pause that refreshes and a consolidation.
So, while gold and silver are at elevated prices, other metals remain undervalued, offering strong potential. Uranium, copper, and rare critical minerals are gaining attention due to industrial demand and geopolitical shifts. These markets are not yet in parabolic phases, making them attractive for strategic investment. Projects that seemed unviable years ago are being revived as technology and demand change economics, giving second lives to overlooked mines. Investors with expertise in emerging metals stand to benefit from these evolving trends. As global supply chains shift and governments prioritize strategic resources, the opportunity for diversification beyond traditional precious metals has never been clearer.
I haven't found anything that's quite undervalued, but again, I'm not looking at any sector, particularly the junior market, seriously anymore. I'm just not. I'm on the way out the door. You're still well in the door, my friend, and I hope you have several more years of great success at all. But what I will tell you this is, I think there's actually two other markets that are safer to play. Not to say that gold and silver is going to go down a lot, but a lot of these things got overextended. And I think there's two markets that weren't parabolic, that whose fundamental argument is actually stronger than gold and silver, given where gold and silver is currently priced. Now, if there's a 10% or even a 20% pullback in those, then they would fit as well. And that's the uranium and copper market. They're only still just fundamentally, stories only getting better, and the prices were not in a parabolic rise yet. And so I think you have to include them looking for undervaluedness along with gold and silver. Now, there's these very rare minerals that neither I can spell or pronounce correctly. And I think that takes somebody with real expertise. But even a metal like now that seems to be interested in, Canada has a company that have been involved in with tungsten or things that we didn't even think of 5 or 10 years ago. If somebody would have came up to me 10, 15 years ago, hey, I got a tungsten play. Go talk to that guy. What the heck's tungsten? That would have been my response. Now it'd be like, come here, I want to hear about it. So there's value out there, and you're right. Those are the things that play. Now keep this in mind. One of the other things that happens in this market is projects that never really worked for one reason or another get born again. I call it the 9 lives of cats. I've seen projects, the names change, companies change, and sometimes even the personnel running it, but it's the same project that was shown to be 20 years ago. But when markets get highly priced, it starts to make sense at this point. But I would not start buying something only because at 4,000 or 5,000 gold it works. You better still hope it works at 2,000, 2,500. Not that we're going back there, but that's going to be a better, safer play than something that needs almost current prices to work out well.
Volatility in gold and silver has reached historic levels, occasionally surpassing entire cryptocurrency swings in a single session. Such extremes often signal market tops or bottoms. High trading volumes, particularly in silver, indicate intense speculative behavior, often driven by short-term retail decisions. Today's investors are focused on immediate moves, trading on emotions rather than fundamentals. Yet modern trading platforms make this easier, with negligible fees amplifying speculative participation. Understanding this behavior is crucial. The market isn't irrational, it's evolving. Consolidation periods provide stability, allowing fundamentals to catch up with market sentiment, creating healthier conditions for sustainable growth and profitable opportunities for informed investors.
The only top that would be is short. There's still a possibility it's an intermediate top, but nothing yet to define that. But I can tell you this, what's happening. The fact that most financing now are bought deals, that's just telling you right then and there that companies don't even have to go out. The investment bankers have people to bring it to them, which makes a world of a difference. 24 months ago, guys had to hit the streets, make 100 calls, and try to put something together. That in itself is an indication. But keep this in mind, and the smartest guy I know, who just had my 3rd conversation with him in 2 days, said to me, remember, PEA to corporates is toilet paper. When you get to pre-feasibility, okay, it's cardboard, we'll take a look at it. And then feasibility is when, hey, it's on really good back paper and then let's go at it. So PEAs are good for individual plays because at least it gives you there's some substance to this thing. It's not a wing and a prayer. But the movement now, remember, is projects just 18 months ago. No one, there were so many companies. I think of my biggest holding, 16 months, 15 months ago, it was 45 cents. It traded up to 350 a week ago. Back to 280 today. That's not uncommon, Steve, to see 500% to 1,000% gains these last year in juniors. Everything needs to consolidate and take breaks. But people only buy if it's going up, it's got to be good news. If it's gone down, it's got to be bad news. And retail, again, they don't have plans. They do from emotion. The price of the stock is telling you whether or not there's good news. Yeah, sometimes that's true, but more times than not, things just don't go in straight lines, up or down. So I'm really happy to see, as you and I speak at least, a pause that refreshes. I hope it lasts for several days, if not a few weeks. I think the juniors need to consolidate and all, but we are nowhere near a major top in either the metals or the mining shares.
The metals market is far from exhausted. Despite recent corrections, fundamentals and investor interest point to continued growth. While gold and silver attract headlines, a diversified approach including uranium, copper, and rare minerals can enhance returns. Institutional involvement is increasing, retail investors are more aware, and geopolitical forces are reshaping resource allocation globally. Consolidation periods offer a strategic moment to evaluate positions without panic. The era of passive speculation is giving way to informed, long-term investment strategies. For those willing to study fundamentals and market dynamics, metals remain a compelling, resilient sector with potential for significant gains in the years ahead.
I think I said it earlier. I never saw a hard asset and a financial asset making all-time highs at the same time. You know, the standard joke I used to have, and I still have it in our financial planning group, was I used to sit with people and they almost all of them would come in and be 98, 99% financial assets, stocks, bonds, and say to them, listen, I want you to buy some gold and I hope it doesn't go up. And almost to a T, they all did the same thing. They give you that puppy look and then go, but Mr. Grandich, why do you want me to buy gold and have it not go up? Because if it goes up a lot, basically what you have here is going to go down. They worked opposite. But to see, as of last week, simultaneously all-time highs being made, you say to yourself, oh, it doesn't make sense. What is going on here and all? The other thing is the volatility. I think today, I could be wrong, Steve, and I didn't have a chance to put it in math, just watching. I think gold's swing ended up being in value more than the entire Bitcoin market, just the whole market, just that one swing. This is unbelievable, the volatility and all. It is, and remember, the biggest swings tend to crest at tops, whether they're short term or at bottoms when volume. The other day we saw in silver where the SLV, unbelievable, traded more than anything else, value 10 times more than it ever traded before. That's usually a signal. Volume usually precedes tops or bottoms in price. And so now, for the best of all worlds, if you're bullish at all, a consolidation period is useful here. But Steve, I don't know how you're following in your group and all. Retail people become so short-sightedness. They have now shrunk long-term down to sometimes just days, if most weeks. And every research report through the 80s and 90s was a 3 to 5 year outlook. You never see a research report that's longer than a 1 year outlook. And retail is much shorter than that. And I think that's also the cause to some of the volatility and all. And part of the reason also is that you can trade for nothing now. I mean, years ago, you buy $10,000 worth of a stock, you were paying $300-400 in commission. Now you can buy $100,000 worth of stock and maybe pay $5 for the commission. So if it goes up a penny, you could make money. That also has added to some of the volatility as well.